We continue with accounting AS, double entry system, going to balancing ledger accounts. So now it said balancing the ledger accounts. The balancing of accounts are done after all transactions are posted. It shows the difference between the credit side and debit side. So the balance is then transferred as a single amount to the financial statement. So that's the point they're making here. I'm just going to that's what I wrote. The summary means when you're balancing an account, the first thing you need to do is you put the debit, you posted the debit side, you posted on the credit side. All assets, revenue, all assets, revenue on the debit side, expenses on the credit side, liabilities on the credit side, your capital on the credit
Revenue.
side, drawings on the debit side. So as soon as all these are done, then there's going to be difference between the debit side and the credit side. So the difference between the debit side and the credit side, whatever figure you have, if it's the credit side that is lesser than the debit side, then your balance carried down will be on the credit side. If the debit side is lesser than the credit side, your balance carried down will be on the credit side. And if whatever you get as a balance carried down, your balance carried down is the difference between the debit side and the credit side. You add it up to the lesser side. So when you add it up, then the account will balance. So that figure that you're adding up with, becomes the balance brought down on the other side that has the highest value.
Okay.
So that highest value becomes the value, the opening balance in the subsequent account. So what I'm saying again is that when there's a difference between, based on, okay, let's look at the wages account here. We have the wages account, the debit side and the credit side, right?
Yes.
So the figures on the debit side, though here they're just telling us that the total of all wages have been taken to the statement of profit or loss account because wages are expenses.
Yes.
So each month, on March, April, May, June, these are different wages of the month, but they will be put together as expenses, wages in the statement of profit or loss account.
Okay.
But in the wages account, the difference between the debit side and the credit side is what we need to understand. So what if the debit side is lesser than the credit side? You balance it up on the debit side. If the credit side is lesser than the debit side, you balance it up on the credit side.
Okay.
So if you are balancing it up on the credit side, you have balance carried down, balance CD.
Yes.
If you are balancing up on the debit side, you have balance CD on the debit side. Do you get it? So if you are balancing up on the credit side, you have your balance CD on the credit side, then that value goes to the debit side as balance brought down, balance BD, below the final figure. Then it becomes the opening balance for the subsequent month.
Okay.
I think the point is clear. Is it clear, please? Yes.
For every ledger you have to balance?
Balance it, yes. For every ledger, because we start balancing.
What if a ledger has only debit side, not credit side?
You put the balance on the credit side.
You put the balance.
You will see it
Okay.
in these accounts. So, what are those steps we need to take when we are balancing accounts? The first step is you find the difference between the debit side and the credit side. So the difference is, the debit side is, because either the debit side or credit side is bigger. One will be bigger than another, but you have to add it up to balance it up. So your account must balance. That is the point. The second point, enter the balance on the side where the total is less as balance CD, which I've already explained. Wherever you have the difference, you add it up, the figure of the difference, you add it up to that side that is having the lesser. You put balance CD.
So the difference you add it to the one that has less.
Yes, as balance CD details.
So if debit has 1,000 more than credit, you will take that 1,000 add in the credit side.
You add it to the credit side. So the 1,000 on the credit side, which is balance carried down, becomes 1,000 on the debit side below the final figure as balance brought down. Clear? So the two sides are now equal and the figures are written on a single line. That's a single line. Then the balance is brought down, which we just explained now. Do you have any question about that? No. So we have activity 9. Olivia commenced business on January 1, 2018. He paid an amount of 11,000 by check as capital and also received a check of 7,000 as a loan from A Turner. The transaction for the 6 months ending 30 June were as follows. So we have the transactions here. We have drawings, we have cash received, cash paid, expenses, credit purchase, cash purchase, payment for motor vehicle, cash sales, credit sales, returns inward, returns outward. So I'm going to take one at a time and I will explain each transaction and what they mean to an account, to the business. So we start with the capital. The capital is the amount of money invested into the business, and that is Olivia. So we have capital account, which is going to have a credit balance on bank and the credit balance of capital, the details will be bank 11,000. I think the point is
And
clear.
the bank will be in the debit.
As soon as
Yeah.
the capital is done, that is the credit entry. Then we
Yes.
have to open a debit corresponding debit entry. So for the capital, which is 11,000, will be credit balance. Now we open the bank account. So all these transactions that we have here, all the ones that are paid for or received will go to the bank account. The other ones that are not paid for, that are on credit, goes to the owner's account, to the creditor's account or to the debtor's account. Are you getting it?
Yeah.
So the creditors are called the trade payables and the debtors are called the trade receivables.
Okay.
So we did account capital, which is 11,000 done. Then in the bank account, we're going to have the first transaction in the bank account will be 11,000 capital on
Yes.
the debit side of your bank account. Then they said 800, we received another check from 800, 7,000 as a loan. So we received a loan from 800 for 7,000. It's going to also be on the debit side of the bank account. Do you understand that?
Debit side, the bank credit.
Because we received the loan from 800.
Yes. Okay.
So do you understand 800
Can you
there?
show me it alone in the ledger?
We don't have to write it on the ledger.
You don't need to write
If,
it.
no, we don't have to. It's a ledger, so it's for 800. We don't need to have 800's account.
Oh, no need, yeah, because it's not our. Okay.
You don't need to have 800's account. But as soon as we are paying back 800, then we open our account for 800.
Because we left the bank.
Do you understand? So that's for 800, which is 7,000 loan. Then we move on. It's going to be in your statement of financial position as a loan. Are you with me?
Yes.
A loan from 800 will be in your statement of financial position as a long-term loan. So you call 800 loan, so on your statement of
Non-current liabilities.
non-current liabilities. Yeah, thank you. You understand that? So we go on. Drawings. We have our drawings account, right? Did I open drawings? Did I? No. So we need our drawings anyway. But okay, it's here, but we can open it. We can open drawings here. Drawings. So we're going to use this for drawings. So we have drawings from the owners of the business, 9,000. So it's going to be on the debit side.
Debit side,
So we have
9,000. Details is gonna be
Bank.
bank,
then we have 9,000. I think it's clear.
And then you're going to write it on the credit side.
That we did that already.
No, you did, but okay.
Yeah. So we have our drawings. So drawings we have a debit entry, bank on the debit side, and in our bank account we're going to have it as a credit entry, 9,000. I think it's clear.
Okay.
Then we have cash received from trade receivables. We received cash
Customer,
from a credit customer.
credit customer.
So it's going to go to the debit side of our bank. So our bank now has 11,000 as capital, loan of 7,000, then the 12,500 received from a credit customer. You got that? On the credit side, up to now we have 9,000, which is for drawings on the credit side. I think it's clear.
Yes. And then
Then-
we got trade payables.
So trade payables are our
Expense.
credit suppliers. We bought on credit from our suppliers. So it's going to be on the credit side of our bank.
We bought in debit.
On credit, you buy on credit.
If you buy on credit, how are you putting it on the credit side?
There's nothing like debit for buying. You buy on credit. A credit purchase or sales means you buy now and pay later. That is what
Buy-
credit
okay,
means.
Do you write it?
It's not the same as credit entry or debit entry.
Did you write it as a Did you write it as a ledger?
Yeah, trade payables. Trade payables.
You see, you put it in the debit.
Yeah, the amount.
Yeah, you got it, and you put it on debit, then you put it on credit. That's what I'm trying to say.
Ah, okay. But credit here means you bought on credit
Yeah.
that you did not pay. So on our bank account, we're going to have trade payables on the debit side for 15,300. I think it's clear. Because it's cash paid here. They said cash paid to trade payables. We paid our trade payables.
Mhm.
So when you make payments, you pay through the bank with your bank account. So your cash trade payables is 15,200. We make a payment there. It's going to be on the credit side because it is payable. Then we have expenses paid. Expenses 7,900 on the credit side. We have credit purchases. So that goes to our purchases account. Credit purchases go to our purchases account.
Okay.
On the debit side of our purchases account. So on the debit side of our purchases account, for the credit purchase, we're going to have trade payables. On the credit side, trade payables. Do you understand trade payables here? We bought goods on credit for 34,200. We bought goods on credit for 34,200. So we're going to have trade payables of 34,200. Do you understand that?
You bought for 34,200 credit purchases.
Credit purchases.
So
You
what
can't
is-
be in the bank.
Why did you not put it in here?
You bought.
You bought.
This is trade payables
This
account.
is purchases.
This is purchases account.
And why did you label it as trade payable instead of credit purchases? Or it doesn't matter?
No, it matters because there's nothing like credit purchases. Credit purchases is the transaction, the name of the transaction, the account, the title of the
Okay.
transaction.
Okay.
The title of the transaction is trade payables.
Okay.
Are you with me?
Yes.
So we're going to have trade payables account. We're going to have purchases account.
Yes. Perfect.
Okay. So for our trade payables now, we are in credit purchases of 34,200. So for the credit purchases of 34,200, we're going to have trade payables account. For the trade payables account, we're going to have purchases on the credit side because the trade payables sold to us.
Okay.
You credit the giver
Yes.
for 34,200. Do you understand that? You credit the giver
Yes.
34,200. Is it clear?
On account.
Trade payables are the credit suppliers.
Okay.
They give us. We bought from them.
Okay.
So the trade payables account will have purchases on the credit side. This is our own account, not the supplier's account.
Okay.
It is open on our own name, under our own account.
Okay.
But we're going to have trade payables there.
Okay.
So for trade payables here, it's for the supplier who has supplied to us on credit.
Okay.
So, and when you supply to someone on credit, you credit the giver, you debit the receiver. We received, our purchases account received from our credit supplier.
Okay.
So we're going to have trade payables account, purchases account. So under the trade payables account, you're going to have purchases of 34,200. Now your purchases account. Credit purchases, that is, because there's a credit purchases, we have trade payables. So under your purchases account, you're going to write trade payables for 34,200. So for the credit entry of trade payables, there's a debit entry of purchases on trade payables.
Okay.
Is it clear? Now, the next transaction is cash purchases. Cash purchases. So it's still going to be under purchases, but it's going to be under on the debit side of the on the debit
And
side
bank.
of the purchases account as bank, and on the credit side of our bank account because we make payments.
Yes.
So purchases was made. So on the credit side we have purchases of 21,900 on the credit side of our bank account, and on the debit side of our purchases account, bank. Purchases under bank, bank under purchases. Do you get that?
Yes.
Is it clear or not, please? Good.
100%.
So we go on to
Payment.
payment for motor vehicle. Motor vehicle. So we need to open motor vehicle account. Motor vehicle account. Did I open that? No.
Okay. No.
No. Okay, we can open motor vehicle account.
Okay.
So for motor vehicle account, for motor vehicle account, for motor vehicle. So our motor vehicle account received. So we have on the debit side date, details,
It's
amount.
payment.
Date, details, amount. So on the debit side,
Why didn't you just do purchases? Because you payment, you paid.
it's an asset.
Asset.
So it needs its own item. This is not goods.
Yes.
When you purchase, it's going to be written purchases.
Okay.
Here they said payment for motor vehicle. So you have a motor vehicle account.
Yes, so it's
So-
debit.
Bank
Bank,
for the amount
9,000.
18,000.
18,000. Oh, yeah, 18,000.
Do you understand?
Yes.
So
And
that's
then
for motor vehicle.
And then you
So
put it on the bank.
to balance this account here, you write your balance CD 18,000. Do you understand? Because they are all 18,000. 18,000. Did you get it?
Mm-hmm.
There's no other transaction for that.
Do you write it in the bank?
No, we balanced the bank already.
But-
we wrote it motor vehicle.
Oh, you wrote it, but you're not writing an account, right?
Yeah, for the individual account.
You got confused, yeah.
Really? Motor vehicle account is fine. Motor vehicle account, we have 18,000 done on the credit side of our bank because it's a payment. I think that is clear. Is it clear, please?
Cash sales revenue.
Cash sales. So we're going to have revenue account. So our revenue account, we have our revenue account.
Yeah,
Yes.
right here.
So for our revenue accounts, we have cash sales, which is going to be on the debit side for 9,400 on the debit side. We received, under the revenue account, we received
Yes.
cash sales, 9,400. Do you get it?
Yes.
Then we have a credit sales
Sales.
of 32,000. So we're going to have trade receivable,
Also.
a credit customer.
Okay.
So for our trade receivable, we're going to have it on the same on the credit side of our revenue account for
Perfect.
32,400.
And then we have returns inward and returns
Now,
outward.
we go to return inward and return
You
outward.
told us return inward.
Return
is credit.
inward is back to the business.
Debit.
Back to the business. That's a debit entry. Return outward is going out of the business. That is
Credit.
credit. So return inward. Who are we returning to? We are returning to our trade receivable.
Receivables.
Our trade receivable returns to us, and our trade payable will return to our trade payables. Do you understand the return
Yes.
inward here? So return inward is for our trade receivable, return outward is for our trade payables. Do you get the point here?
Yes.
So for returns inward, we have 325 for return inward. So we go to our trade payable account, our trade receivable account, sorry. Our trade receivable account, return inward, because we're going to take the difference away. Do you understand?
Understood.
So we take the difference away. Do you understand that? That's on the credit side of our trade receivable account. Then we go back to our return inward account on its own. It's going to have a debit entry. Returns inward account, we
It's
have
debit entry.
debit entry, yes, for trade receivables.
And trade outward credit.
Return inward, the details will be trade receivables.
Okay.
Do you understand that? Then we have returns outward,
Yes.
which is for our trade payables account. So we're going to have return outward account, which is going to have a
credit.
credit entry
And a debit.
and a debit entry under trade
Trade
payables
payables.
account.
Perfect.
Because our trade payables has received the
Mhm.
supplier, when the supplier was giving us, yeah, we have a credit entry. But now we have, the supplier is receiving from us, it's going to have a debit entry.
Okay.
When we sold to our credit customers, we have a credit entry. Now we receive from our our customer returned some of the products back to us. We're going to have a debit entry. Some reasons why customers might return goods are because one, the goods might be damaged, they might be expired, and it might be based on the quantity.
Maybe the
quantity.
quality.
No, the quantity. The quantity given is more. So we needed 5,000 products, and you have given us 5,200.
So we have to pay. Yeah.
So on
maybe
the
less
invoice,
quantity. Maybe less quantity.
yeah, more quantity. If it is more,
Maybe less. No.
if it is less, then
Yeah.
you issue.
Or they bring you
Well, if it is less, you issue a debit note.
debit note.
We're not there yet.
But Mister, if it's less, you're gonna ask for more. So you're gonna do a new ledger for the extra 300.
You use a debit note.
Debit note. Okay.
There's a debit note and credit note for that. We're not there yet, okay? But here, reasons why customers might return goods are because the goods are damaged or expired, or the quantity required is more than what is being, the quantity ordered is more than what is, the quantity supplied is more than what is being ordered.
Okay.
Do you understand? So these are the reasons why customers might return the goods, or difference in colors. We wanted blue colors, they gave us green
Yes.
colors. Do
Let
you
me read the
understand?
question. Show the
So-
bank account or cash at bank.
So here, so all the transactions are done already, and we have to balance. Now, how do we balance? We start with the bank account. So based on this, our credit side of the bank account is more than the debit side of the bank account.
Mm-hmm.
When we added up all the credit side of the bank account, we had 72,100. The 72,100 minus the debit side of the bank account give us this. So we have 72,000. The debit side is 11,000 plus 7,000 plus 12,500 plus 9,400. That's the debit side of our bank account. It's 39,900. And the balance on the credit side is 72,100. So minus 72,100. So we have 32,200. So the balance carried down will be on the debit side, because the credit side is larger or bigger than the debit side.
Okay.
So balance carried down will
we
be
took 72,000. We minus it by this. It was 30.
it's 2,200.
Yes.
So that's our balance carried down.
Okay.
So the balance carried down on the credit side goes on the debit side will become balance brought down on the debit side. Is it clear? Is it clear, please? Okay.
What's
Then-
the total of this? What's the total of this?
72,000.
And this.
It has to be on the same line. So the difference is 32,200.
Oh.
So it makes it to balance now. So the difference between this side and this side is 32,200.
200. How much is the total of this one?
39,900.
32,000.
39,000.
Where does it say 39,000?
When you add this together, it gives you 39. 39,000 plus 32,000 gives you this.
Where do you bring the 32,000?
11,000. 11,000 plus
This is 11 plus.
Hold
7.
on, please.
Okay.
7,000 plus 12,500 plus 9,400. 39,900. The balance, the items on the debit side are capital, loan, receivables, and revenue. It gives us a total of 39,900.
Mm.
The balance on the credit side of our bank are The items there are drawings, payables, expenses, purchases, and assets. The total on this side is 72,100. 72,100 minus the balance on the debit side, which is 39,900, becomes our balance carried down of 32,200. You won't write 39,900, you can't write it here.
Okay.
You write the balance carried down, that is the details.
Okay.
You add it up to the total of the items on the debit side. It gives you 72,100. So your account is balanced. So the balance carried down, which is 32,200, you take it to the credit side, which has the largest number, as balance brought down of 32,200. So your bank account now is having a credit balance of 32,200.
Let me just ask you something. You added all these 39,000. You got 72,000 from these.
Yes.
You took 72,000, you minus it by 39,000. The answer was 32,000.
Is your balance carried down?
Yes. And then you made it equal to this one.
It's equal now because this, when you add it to all this, it gives you 72,100.
72,000. When you add 39,000 plus 32,000, it's 72,000.
Yes.
So 72,000, 72,000.
Yes.
Why did you write here 32,000?
When I was explaining balancing for you, I told you the difference between the debit side and the credit side.
Yes, it carried
On
down.
the lower side is the credit, balance carried down. And on the debit side, it becomes balance brought down. Here, we have our large number on the credit side, on the debit side. Then our less number is on the, our large number is on the credit side.
Yeah.
Our less number is on the debit side. So that means our balance brought down will be on the credit side.
Okay. On the
Now,
debit side.
what does this simply mean? Having a balance on the credit side means you are owing the bank. Do you understand? You have withdrawn, you have spent more than what you have in your bank account.
Okay.
Do you understand? So a credit entry like this in your bank account means you have withdrawn more than what you have in your bank account. And this will be as a result of an overdraft. So this is called an overdraft.
An overdraft.
Yes, because you are having a credit balance in your
Okay.
bank account.
Okay.
Your bank account is supposed to have a debit,
Yes.
but it's having a credit. It means you have withdrawn more than what you have in your bank account.
Okay.
So if this happens, it means the bank has given you a facility to overdraw your account.
Okay.
Is it clear now? That is how we balance. So our balance is 32,200, balance brought down. So your bank account going forward to the next month will be 32,200 on the credit side.
Okay.
Do you understand? Is it clear, please? Is it clear or not?
Yes.
Okay. So that's how we continue with other balances. Here we have our returns out, or you just balance it. It has the entry is on the credit side, you balance it on the debit side. The entry here is on the debit side, you balance it on the credit side. The entries there are on the credit side. Your balance carried down will be on the debit side, and your balance brought forward will be on the debit side.
Because this has more than this.
This doesn't have any transaction revenue. It's always going to be a credit entry.
Yes.
So the balance will be on the balance carried down will be on the debited side. For return inwards, the entry is going to be on the debit side. Your balance carried down will be on the credit side.
Okay.
Do you get it or not, please? Return inward. When we did the return inward, the entry was on the debit side. Yes or no? So when we have to balance, we balance on the credit side. Because there's nothing on the credit side for return inward.
Okay.
Return inward means we receive from our customers. It has a debit entry.
Yes.
Then we need to balance the account. We balance it with the same amount on the credit side as balance carried down. Then our balance brought down will be on this side because the transaction should be on the debit side.
Okay.
Same goes to revenue. Revenue is going to have a credit entry. The total credit entry on the revenue is 41,400. 41,000, sorry. On the debit side, we're going to have it as 41,400. If your entry is on the debit side, your balance will be on the credit side. If your entry is
If
on the
your
credit,
entry is on the debit side,
your balance carried down will be on the credit side. If your entry is on the credit side, your balance carried down will be on the debit side. This entry revenue is on the credit side.
Okay.
This entry revenue is on the credit side.
And
Your balance carried down on the debit side. Your balance brought down goes back to the debit side. Return inward is a debit entry. The balance carried down will be on the credit side. Your balance brought down will go back to the debit side. Return outward is a credit entry. Your balance carried down will be on the debit entry. Your balance brought down will be on the debit entry. Drawings is a debit entry. Your balance brought down, your balance carried down will be on the credit entry. Your balance brought down will come back to the debit entry. Capital is a credit entry. Your balance brought down will be on the debit entry. Your balance carried down will go back to the credit entry. Is it clear now? Where?
I have to revise that. Okay.
Trade payables. Trade payables are our credit suppliers, yes or no? They receive from us. They're going to have debit entries, yes or no?
Yeah.
So that means our balance carried down will be on the credit side.
Yes.
So because it's trade payables, our total will be purchases, 34,200, and the balance will be on the debit side.
Okay, I'm gonna revise. I have to revise what videos.
Okay.
That's too much.